Recently, my wife had to go through a surgery. And after the surgery, as you can imagine, the bills started coming in. One bill from here, one bill from there, doctor's bill, hospital bill, anesthesia's bill, lab bill, all kinds of bills. And that is when I logged into my HSA account after a long time. Honestly, I had not checked it carefully in years. I knew I had been contributing to it. I knew some money was going in there, but I had not really paid attention to how much had accumulated. And when I logged in, I was pleasantly surprised. There was around $80,000 sitting in that account. And the surprising part was that I knew I had not contributed that much money myself. So, how did it get there? The answer was simple. The money had been invested. Over the years, because that money was invested in the market, it had grown. In fact, it had roughly doubled over time. And that is when I thought more people need to understand this HSA thing. Because many people think of an HSA as just a medical spending account, but it can be much more powerful than that. It can be a tax strategy. It can also be an investment account. It can be a retirement account. It can be a retirement healthcare account. And for the right person, it can be one of the most powerful accounts available. So let's break it down in a simple language. HSA stands for Health Savings Account. It is an account that lets you put money aside for medical expenses. But this is not just a regular savings account. It the account gets special tax treatment. Now, for first of all, before even you go there, not everyone can open and contribute to an HSA. To contribute, you generally need to be enrolled in what is called an HSA qualified high deductible health plan or HDHP. That part is important. Not every high deductible plan automatically qualifies. It has to be HSA qualified. So if you're choosing health insurance through your employer or through a marketplace, you need to specifically check whether the plan is HSA eligible or not. For 2026, the IRS contribution limits are 4,400 or for self-only coverage and 8,750 for family coverage. And if you are 55 or older, you can contribute an additional $1,000 as a catch-up contribution. Now, these numbers change from year to year, so you should always check the current year's limits. Now, why is this account so powerful? The biggest reason is the tax advantage. At the federal level, an HSA has what people often call as a triple tax advantage. First, the money you contribute can reduce your taxable income now in the year you contribute. Second, the money is invested, the growth can be tax-free. And a third, when you withdraw the money for qualified medical expenses, that withdrawal can also be tax-free. Think about that for a second. With a traditional 401k, you may get a tax deduction today, but you pay taxes later when you withdraw. With a Roth IRA, you contribute after tax money, but qualified withdrawals later can be tax-free. But with an HSA, if you use properly for qualified medical expenses, you may get tax benefits on the way in, tax-free growth while the money is invested, and tax-free withdrawals at the way out. That is why people call it triple tax advantage. Now, so it's kind of like 401k and Roth combined in a way. Now, what can you use the money for? You can generally use HSA money for qualified medical expenses for yourself, your spouse, and your dependents. That can include doctor visits, prescriptions, dental expenses, vision expenses, and many other eligible healthcare costs. You can use the HSA debit card directly, or you can pay out of pocket and reimburse yourself later. That second part is important. You do not always have to reimburse yourself immediately. You can do it literally years later if you wanted to. Let's say you have medical bill today, you paid from your checking account and you save the receipt. Later, you can reimburse yourself from the HSA as long as it was qualified medical expense and it happened after the HSA was established. This is why record keeping matters. You want to keep your receipts. You want to keep proof of the expense. Because if the IRS ever asks, you need to show that the withdrawal was for a qualified medical expense. When you file taxes, HSA activity is generally reported on Form 8889. Now, that form reports contributions, distributions, and whether any part of the withdrawal is taxable or not. Now, here is where I think many people miss the real power of HSA. They think, okay, I put the money in and then I use it when I go to the doctor. Now, that's fine. There's nothing wrong with that. But the bigger opportunity is this: many HSA providers allow you to invest the money. That means the money does not just sit there as a cash, it can grow. In my case, my HSA is with Optum, and they have investment options, including index funds. So over the years, my HSA money had been invested in index funds. And because of that, the balance grew significantly. That is what shocked me when I logged in after many years. I had not personally put in $80,000, but because I contributed consistently and because the money was invested, the account had grown. Now, this is a very important mindset shift. And HSA is not just a place to park your money for next month's doctor visit. For the right person, it can be a long term investment account for future healthcare expenses. And this becomes even more powerful as you get older. Because let's be honest, healthcare expenses usually do not go down as we age, they usually go up. So you may be healthy today, you may not have many medicals billed today, but when you're older, there may be more doctor visits, prescriptions, procedures, dental work, vision expenses, Medicare premiums, and other healthcare costs. So if you contribute to HSA now and invest the money, you're building a healthcare bucket for later in life. Now, that can be very powerful. Now, there's one important California angle that I have to mention. At the federal level, HSAs get very favorable tax treatment, but California does not fully follow the federal HSA tax rules. So if you live in California, the federal tax benefit is still there, but the state tax treatment may be different. This is one of those areas where you definitely want to talk to a CPA, especially if you are contributing larger amounts or investing HSA money. For many of my listeners, especially high income professionals in California, this detail matters. Now, another interesting tidbit is that what happens after the age of 65? Before the age of 65, if you use HSA money for non qualified expenses, meaning non medical expenses, you generally owe ordinary income tax plus a penalty. But after age 65, that penalty goes away. So if you use your money for qualified medical expenses, it can still come out tax free. But if you use the money for non medical expenses after age 65, you generally pay ordinary income tax on it, similar to a traditional IRA. That means it almost gets converted into traditional IRA. So, in the worst case, after age 65, the HSA can behave like a traditional IRA. But in the best case, if you use it for qualified medical expenses, it can be even better because the withdrawal can be tax free. And that is why I think HSA is underappreciated. The simple takeaway is this: if you are eligible for HSA, do not ignore it. Understand it. Fund it if it makes sense for your situation. And if you can afford to invest the money instead of spending immediately, it can become a powerful healthcare bucket for later in life. That combination of tax advantages, investing, and the time is what makes the HSA so interesting. Thank you for listening. This is the OMC Real Estate Podcast, and my name is Vaibhav Puranik. Our website, oldmoneycapital.com, has a lot of interesting information like this. You can hit request a call button on it so that we can educate you on multifamily syndications. Our YouTube handle is Old Money Capital and our Instagram is Old Money Capital 123. Thank you again for listening.